All right, guys, welcome back to another week of the Educated Homebuyer Live, where Josh and I are continually wrong about inflation as it soars and interest rates go up, and we have absolutely no idea what we're talking about. But the good news is we're here, we're having fun, and we can educate you when it comes to real estate and mortgage. So if you have questions, put them in the chat while Josh and I banter back and forth and update you on what's happening in the economy. Josh, how are you this week?
I'm delirious, as I was saying as we're coming. I'm delirious with joy, with happiness, with all of the good and interesting news. You know the old Chinese proverb, "May you live in interesting times." I am tired of living in interesting times. I would like to live in boring times. I'm an old man. I just want to relax.
You get
Just
to
want
live in
things to be.
interesting times. That's the positive outlook on that. You get to do it. You know, it would suck if you didn't get to do it. You know, that means you would be dead.
It's better than not living in interesting times.
Exactly. So you guys know inflation came out today, a little bit hotter than expected, 0.1 higher. We're
This much
sitting,
higher.
yeah, just a smidge, but enough to send the bond market higher and mortgage rates likely higher. We'll get an update from Josh on that here momentarily. But we're going to start, as we always do, by taking a look at some of the charts. So, Josh, let's see if we can do this here. I can't do it. There we go. As we always do, we like to take a look at inventory because inventory is kind of a leading indicator as to where the market's heading overall. We always talk about real estate being local. In fact, we had a really good conversation today with Lance Lambert, which will be our podcast next week. It'll be a really, really good podcast. If you don't know who Lance is, he is basically the owner, CEO of Resi Club, which is a data provider nationwide for essentially all markets. But he's written for Fortune. He's written for Bloomberg for 10 years plus. Really good grasp on the housing market, and he's going to bring a lot of knowledge and expertise to the conversation that we're having that'll be posted on Tuesday of next week. But anyway, supply and demand's what drives markets. We saw a little tick down week over week. All of a sudden, I got super stuffy, Josh. Just like, I don't know what happened.
Too much
Yeah,
partying
like,
on the soccer field. Was it soccer or
possibly.
flag football? What was it today?
I was on the soccer field prior to coming here. And yeah, all of a sudden my eyes, my nose, everything. But anyhow, we actually saw a tick down in inventory from last week, right? This is the time inventory should be growing. But guess what? It was Easter week, which could play a part on those inventory levels. We actually saw it drop from 517,000 to 513. It's a notch down, but still sits 25% more homes on the market right now than a year ago, which is the key. Yep. And as Lance mentioned, context, we're still 38% below pre-pandemic levels. So yes, we're up, but still we got a ways to go before we normalize.
Every week when you go through these charts, I look at this one and I'm looking at the shape. The levels are up and down year over year, but I'm looking at the shape. Does it deviate from what we had? So you look, and I heard that same explanation you did. Hey, Easter week, less people list their home and there's a dip there. But if you look, Easter week moves forward on the calendar. It's not a calendar date, so that weekend moves every year. But if you look, some years, like the blue line up here, 2018, looks like Easter week had a big dip. And then you look at the green one, 2019, I don't see any Easter dip. So it's weird. It looks like about half the years we get an Easter dip, and some years the heathens don't celebrate.
Exactly. And so we're going to look at, we'll talk about that week in the year here in just a bit. But Orange County sitting at 2,123 homes, Huntington Beach at 135. So Huntington Beach is about the lowest level I've seen it since probably going back to 2022 with regards to the level of inventory. Again, real estate's local. Florida, Texas, a lot of these markets seeing an increase in inventory. Here, locally, we're not seeing that increase. It's being met with buyer demand and taking homes off the market. This is what I summarized earlier, which is we fell from 517 to 512-ish, 513, if you will, week over week. This same week last year, we still saw an increase, but this week last year, Easter was actually a little bit later, which we'll see here in just a minute. But we went from 410 to 411 or so last year. The peak last year in 2023 was at 570. So we're still well below that peak, but that peak happened in May. So it'll be interesting to see if we peak around the same time or if we pass it or what it actually looks like. But that's going to take us into new listings, Josh. So new listings, we're actually down 8.5% for the week. As I mentioned, it was Easter holiday this past week, only saw 55,000 new listings. So that's down again, 8.5% and 1.5% from last year. Now, because of the mismatch holiday week, this is the first time since way back at Thanksgiving that new listings didn't show year-over-year gains from the previous year. So interesting to note there. But Mike Simonson says that means that next week will show big gains both weekly and yearly in new listings volume because of the holiday being gone and whatever happens. In theory, that's what happens. So that will push us into looking at new contracts. So new contracts pending, home sale contracts dipped. Again, a lot of it has to do with Easter. 65,000 new pendings this week, which is just fractionally fewer than a year ago. And then that'll take us looking at home prices. So home prices, median price of new homes into contract is now at $395. That's up nearly 6% over 2023. And the price of new pendings is just 2% above the 2022 levels. And then lastly, we'll take a look at percentage of properties that are taking price reductions, now sitting at 32%, which is still in that quote unquote normal market that we often talk about. So as I always mention, guys, if you're hearing this and you're wondering, what are they talking about chart wise? We'll put a link in the description if you're on the podcast listening to this on Friday, because we do take this episode and put it on the podcast on Friday. There will be a link in there to check out these charts. But Josh, let's talk about non-farm payrolls, which came out last Friday.
Yeah. So last Wednesday, we were talking about big data week, right? The Fed's two most important things that they're looking at right now is payroll and inflation. They prefer CPI, or PCE, but the market has been trading CPI. So we got both of them since the last time we were here with you guys. I saw several crazy headlines that actually called it a blockbuster jobs report. It certainly was not a bad jobs report, but we're going to look at a piece of data buried deep down in that if you look at the headlines, you just see what the media is reporting, what sells, what gets people to click and open and read articles. Hey, it was an awesome jobs report. Unemployment rate went down, many jobs created. So the orange line here is a three-month trailing average. So you can see after descending from July of 2021, we were coming out of COVID and the lockdowns, jobs picking up, and then started a pretty significant downtrend from July 21 through about July of 2023. Decelerating in that slowdown, but now it's definitely turned back up, and it has some people saying, hey, we have a really hot jobs market, and the Fed is looking at that and they will not cut until something breaks in the jobs market. Well, one of the people that we like to follow, read him every morning, Peter Bookvar, is the genius nerd that digs into this stuff and reads the details. So he says the mix, though, of this is important to note. All meaning all jobs came from those aged over 55 and under 25. There was a drop in household employment for those aged 25 to 54, the key working cohort. So bonds and mortgage rates did not like this strong jobs report on Friday. The headline said it was great. When you dig into it, it's definitely mixed. You can't say it was a terrible jobs report, but not as strong as thought until something changes and it goes outright bad. The Fed's not going to do anything. So with that, Jeb, we got the CPI data today. You can see what happened here. We had peaked back up in March of 22 was when we hit 9%.
I close my eyes. I can't see it. I can't see the inflation report.
Your eyes are puffing up.
I close it. My ears are closed and my eyes are closed. I have no idea where inflation is. Still trending down as far as I'm concerned.
Coming out of COVID, we were actually at 0% inflation, ran that all the way up to 9% and saw a really precipitous drop back down to just under 4%. We were expecting this to continue, that trend to continue. And January, February, March reports, we're in April. We've got all three reports here. They have not cooperated. The initial thought was that January was hot because of some of the annual changes in the components that might continue trickling into February. We're now into March. None of those were super hot CPI figures, but they were all better than expectations for 3 months in a row. And most importantly, they broke that trend of moderating inflation. So now everyone is calling into question, hey, is inflation actually moderating? Is it about ready to kick back up? What does that look like? This is just the month over month chart. So you can see the last 3 months, those aren't terrible numbers, but those are numbers that are equivalent to about annualized inflation. So next month we have a better number falling off. If we hit next month's expectation, we should see a marginally better CPI. But the important thing about this is the first 3 months of this year, we need to get through 12 more months for those to fall off. And until they fall off, unless you have some really like 0% month over month change, 0.1% month over month change, it's going to be slow progress towards the Fed's preferred 2%. This one, you guys watching at home probably want to see this one or don't want to see this one more than any or all of the others. So this shows what prices would have looked like, the blue line, if we had stayed at the 2% inflation that the Fed's preferred rate. Now, what we've had since COVID is that red line, and prices there, what? We got 30 bips, is about 11. Well, look, they did the math for me, Jeb, 11% above that 2% inflation trend. So we've shown the chart on the show, Jeb, where we're like 30-40% cumulative inflation over the last 3-4 years. But taking into account everything from the beginning of COVID, that initial dip, we're about 11% above where we should be, and no real signs of moderating. This is an interesting chart, just shows that this is the fourth longest period of time that the US has stayed above 3% inflation. We're going on 36 months above 3% inflation. Within a few months, we're going to be even higher on that list if something doesn't turn around. So here's the important part, Jeb. CPI came out at 5 o'clock this morning for us Pacific, 8 Eastern, and you see that was pretty much the market actually dipped for a second. They assimilate the data in a few minutes, and then it shoots up. The 10-year went from what, about 434 to 450, traded sideways, and we had a chance that generally, or oftentimes, if there's a treasury auction the same day as a big market mover like this and the yields move in the morning trading, that will bring buyers in during the auction and say, hey, if I had just gone into the market and bought treasuries this morning, the 10-year would have been at 434. I can buy at 450. So a lot of times that attracts buying and pushes the yields back down. Very bad 10-year auction. You see another spike up there to about 455, and we closed at 453.
Yeah, and note, Josh, like when we talk about nobody wanting to buy at 454, that's not a good sign for bonds, right? It often means that they think they're going higher and can get a higher return, and therefore are waiting to purchase, and likely means we're in for a number with a larger print, if you will.
Yeah, I stopped saying these things because whenever I do it over the last few years, we have just run through these measures, but we've got a little support. I think it's at 455, 457, a little more behind that at 465. And if those give way, we are probably looking at what our friend Peter Bookwar has been calling for, is another run at 5%, which would get you mortgage rates back in that 8% range. So I thought this was interesting. Jeb, Mortgage News Daily actually updates every afternoon, and they are reporting here a 30-year fixed at 7.34. My rate sheets were not quite that bad. They may catch up to that tomorrow. I wasn't going to throw in Optimal Blue because they're always a day late, but then I said, wait, that would actually be instructive. A lot of times people will say, well, wait, yesterday you told me the rate was 6.875. Why is it 7.25 today? Like, well, the market moved. The market doesn't move that much in a day. So Mortgage News Daily has it at 7.34 today. Optimal Blue's data from yesterday was 6.866. So it was a big move, depending on the lender, depending on the program, 1/4 to 3/8, almost a 0.5% move in interest rates today.
All right, guys, nothing of what you wanted to hear. So, we're going to just, we're going to move on from that. That's bad news, Josh. You came with bad news. Nobody wants to hear
I did. That. Let's jump into this comment because I like this. I like this thought because this is the thought kind of that's been rattling around in my brain. I'm sure you've been thinking as well. Joey says, higher for longer isn't the worst thing for the housing market. Frankly, it's pretty interesting and I guess impressive that our economy continues to be as strong as it is. Definitely interesting. As recently as 6 months ago, Jeb, we're looking at the charts and saying, hey, the excess savings from the stimulus is going to work its way through what did they say, October, November of last year, that it would be completely gone. And here we are. It's gone. We're 6 months past it and spending is still strong. If you dig again into that CPI report, core goods is well contained under 2%. It's services. It's eating out, things of that sort, high-end travel that's really elevated. And it will be interesting to see how long people can continue spending. And if the jobs report, if employment stays strong, people are seeing 4%, 5%, 6% year over year increases in their wages. Maybe it's longer than we all thought.
We keep spending until we run out of money, Josh. It's real simple. Like,
Apparently. So when
I
do we
mean,
run out of money is the
I
question.
don't know. I hope never. We just keep spending. It's spending. We keep printing it. And I apologize for anybody listening. My nose is completely clogged here. So if I keep going to mute and whatever else, it's because I'd rather do that than snort into the microphone here. But wow, 30 minutes on the soccer field for my youngest, and I come back in here and my eyes and everything are itching and what have you. So we don't really have a lot of questions at the moment. So guys, we're here to answer questions. That's the primary reason we do this show. And we can't do that without you guys. Josh and I can talk as much as we want off camera. We don't need to be on camera to have a conversation with one another. So if you guys have questions, that's what makes this actually work. So put them in the chat. We'll get to them, and help you guys become educated home buyers. That's the goal here. But with that, I do want to ask a favor. If you haven't listened to the channel before, first time here, you've been here before, you haven't subscribed, do us a favor, hit the subscribe button. If you haven't been over to the podcast, or if you're on the podcast and you haven't been over to Jeb Smith, do that. It helps out, my algorithm, helps out the podcast algorithm, and ultimately, helps me accomplish the goal of why we started the channel, which is to help others. And if you want to get in touch with Josh, trying to do a loan, you want to be with our team, work with, us and, our referral partners, there's a link scrolling the bottom of the screen that should get in touch with us if that's working properly. I don't know. Is it scrolling there, Josh? It's not, right?
It is. It popped up, okay, and then it disappeared, and then it came back.
There you go. All right, guys. So there was a question here that we're going to get into. It says, are there more cash buyers since rates are so high? I don't know if there's more. More than what, right? I mean, more than 19.
Our friend Lance Lambert has the numbers, so while you're answering, I'll track it down.
But I do believe there's more cash in the market than I've ever seen. I just don't know what we're comparing it to. As I mentioned a couple weeks ago, I sold a property here in Huntington Beach. It actually closed yesterday, and 4 of the 5 offers were cash offers. That's a lot of cash, guys. And my client actually was buying a more expensive property, and he put nearly 50% down actually over 50% down when he bought that property. So there's a lot of cash in the system, primarily because people owned real estate during this big boom cycle and saw a lot of appreciation, especially if you've owned it, since 2015 or more. I mean, you've gotten 100%, return on your investment, or I can't say your investment. You got way over 100% return in your investment. But you've got appreciation at 100% in a lot of markets out there. And that's giving people buying power. And that's the reason the market's still going bananas in many of these markets out there.
Jeb, I got the data here. And
go.
I think it's a free article. Some of the articles at Lance's site are free. It's resiclubanalytics.com, RESI clubanalytics.com. But for Q4 of last year, cash buyers were 33.5% of the market. And that's up from 27% in Q1 of 2021 when rates were down around 3%. So up 5 to 6% from when rates were lower, when people can't borrow as cheaply. If they have the cash, some people will just choose to do it. He's also got a really cool chart in here that has like 100 markets in the country and lets you know how much cash is in your market. You're still muted. You're still muted, Jeb.
Damn. Sorry, I tried to mute myself because I was snorting and I didn't know that I was. Yeah, anyway. How does a renovation loan work with conventional loan when buying a house that needs updates? Is that smart, or is it just easier to buy it and figure it out later? So Josh, 203Ks with FHA. Well, this is conventional. So you have
home style renovation. They're similar. There are some differences. There's some differences with the conventional in terms of what you can do. You can do some additional things with a home style that you can't with a 203K. As always, the conventional is a little bit harder to qualify for, but they're both really good programs. If you have the cash available and you're comfortable putting the cash into the home and trapping it there and only being able to get it out with the cash out refinance in the future, that can be a good option. The benefit of doing it with the home style is you're going to end up with a bigger loan. That is your acquisition loan, and you can refinance that with a rate and term refinance later on down the line. So it's an awesome program, a lot of flexibility. It's not quite as vanilla and simple and easy as a regular purchase loan, but there can be some benefits above tying up your cash.
All right, good stuff. And then Vantage scores versus FICO scores. Josh, what's the difference?
A completely different algorithm. They access a lot of the same data. In probably a year and a half to 2 years, Vantage scores will be an option for mortgages. As of right now, FICO has a monopoly on it. We're going to be going to not needing all 3 scores, being able to do 2 bureaus, being able to use Vantage or FICO. Vantage is a much better score. I did a podcast or a live video probably 2 years ago with the guys from Vantage Score, and they have a whole deck on the percentage of Americans. It was like 4 or 5 million Americans that do not have credit scores under FICO will have a credit score under Vantage, and disproportionately those are people of color. So it is important that we get away from this really outdated FICO model and get something better. And hopefully in the mortgage space, being able to choose between the two, they will sort of battle it out and focus on getting better data and better and more accurate scores. I'm sure we'll see headlines saying that the mortgage world is going to hell because now we have different scores and it's easier to get a higher score, or people that didn't have scores now have scores and they shouldn't be buying homes. But long answer to a short question.
All right. Well, this question, we should have answered this one earlier on, but are there going to be rate cuts this year? The consensus is still yes, that there are going to be rate cuts. The number of rate cuts and by how much is in question at the moment, depending on what source you read, who you're looking at. After today, I'm sure the data is probably looking, I think June's kind of off the table based on where the data that we saw today. And so you're looking at maybe 1 to 2 cuts based off predictions. So, but again, that's neither here nor there. You got a lot of time between now and the end of the year and what happens with, the labor market, as well as what happens with inflation that will dictate the direction that they go. I mean, they could always do one big cut in a meeting, 50 basis points versus 25. And so you could get, a decent move in one meeting if the data presents itself in the way that they feel is necessary to start doing that. So I do think you'll see cuts. I just don't know how much.
The FedWatch tool is saying 45% in September, 42% in November, and then down to 34% in December. And if you look at the overall probabilities, I looked at them in a different view earlier today. It was 100% probability of 1 cut still, according to the futures, and like a 40% chance that there's 2 cuts.
All right, good stuff. We got Jason Walter. Many of you guys know Jason has a YouTube channel out there, 100,000 subs. Good resource, especially if you're living in California. It's a good place to look for information. He stays really up to date on everything that is trending. But he just says Resi Club's an awesome resource. So, it's used by professionals like ourselves. It can be consumer facing. It's really good data. It's we talk about real estate being local, Josh. It is a really good place to get local information because people often ask, "Hey guys, what's going on in Oklahoma City?" And we're like, "We have no idea what's going on. Like, we're in Southern California." That's a good place to go get that data if you're curious about that market.
And it's cheap. It's less than $20 a month. So some of this stuff is free. The inventory tracker and all that fun stuff is a cost, but it's like less than $20 a month. It's an awesome resource.
A couple questions on California Dream for All. Those of you out of California are probably tired of hearing this, but we're going to answer it because we're in California.
I might be tired of hearing it.
If you want to see if you're approved for California Dream for All, there's a link scrolling in the bottom there that'll get you in touch with our team here and can guide you through that process. But Josh, we got one question from Kim asking how many applications you received. She's trying to see how much competition she has. And then we got Smart Fox asking, can you qualify if you're retired for California Dream for All?
So, Kim, I haven't totaled it up. Last year, we got, I think, 32 applications. I can say I've talked to 3 or 4 people a day every day this week about it. Some of those people don't qualify. They're either not eligible or they don't have income, things of that sort. Free money makes people call with crazy questions. But the question on if you're retired, can you qualify for? Absolutely. A retired person can always qualify, assuming they have enough income. So do we have a pension, Social Security? Do we have money in the bank, in an IRA that we're doing distributions from? Yes, you can, but we absolutely do have to have income, and there is no alternative income qualifying. They underwrite for California Dream for All to the Fannie Mae guidelines, but it's more restrictive than Fannie Mae in terms of debt to income, credit score requirements. I should say for some people, it's more restrictive debt to income wise, even above and beyond Fannie guidelines.
All right. All right. I'm going to try this one, Josh. I don't know if it's a good idea. We got, let's see here.
You're from Kinston. You can do it.
Are they? Laquania? That's what we're going with.
I think you threw an extra I in there. I think it's just Laquana.
All right. That was an I that I threw in there. I didn't even know which letter I threw in.
And you pronounce it as an NIA, like California.
Yeah, why not? Sometimes words don't make any sense. Pterodactyl, for example. How's that start with a P? Tell me who said that starts with a P. But anyway, funny story. Off subject. My youngest, he's 5. They were learning words in preschool, and they, each week there's a letter, and then if they know 3 words, they're supposed to say the 3 words, and they can raise their hand and speak. So I tried to get him to say pterodactyl, and my wife was like, "There's no way. Like, the teacher is going to think that starts with a T." I'm like, "That's the point. Like, he's right and she's wrong, and she's going to have to, go look it up. It's going to be fantastic." Anyway,
she says you were close, Jeb. She says you were close.
Okay. Are we going Laquana? Is that what we determined?
Let's stick with
All right. That's what we're going with.
So
I'm under contract. This is a good question, because this often there's this perception that if your appraisal comes in higher, there's something you can do. So the question is, I'm under contract. The appraisal came back higher than my asking price. So my question is, can you do a HELOC at the same time as closing your loan? So Josh, how does that work when the appraisal comes in higher than the value?
The short answer, HELOC at closing, no, but there may be an option after closing. In terms of your first mortgage, the way we usually hear this question is, hey, my appraisal came in much higher. Can I get rid of mortgage insurance? The lender is always going to use the lesser of the appraised value or the sale price. So it appraises for $1 million and you're paying $200,000. Well, congratulations, you got a lot of equity, but for the loan to value is going to be determined by the lesser of, which would be the sale price of $200,000. So from that perspective, there's nothing you're going to be able to do. Now, from a HELOC perspective, I don't know. We've got 20 different options. It's not like Fannie, Freddie, FHA, VA, where there's just a handful and we know the guidelines like the back of our hand. On the HELOCs, it's going to be up to every individual lender and bank. Will they let you use the appraised value immediately after closing, or do they make you season that for 6 to 12 months? My guess is most of them are going to have a seasoning requirement, but if you really, really, really wanted to HELOC immediately, call around. You might be able to find someone that allows you to use that appraised value immediately after closing. But remember, they're probably going to do their own appraisal, and their appraiser has to come to the same conclusion as the one that did the initial appraisal.
All right, good stuff. Mina, again, coming in weekly with the $5 super chat. Much appreciated, Mina. Thank you for being here as always. And that takes us into the community that we started on school. If you guys are looking for a little bit more information, updates, videos weekly, just talking about the stuff that we kind of dive into at the beginning of the show here to give you context on what's happening in the market. Josh throws those out. We put a lot of data stuff in there. There's actually a link in the description of the video where you can become one of the members of it. We're keeping it at $5 for the first 50 people. After 50 people, we're going up to $20. So if you're interested in becoming a part of it, you can get in now before the price goes up. I know it's like, hey, we've got this great offer but in all seriousness, you can be one of the early ons and support the channel, because that's really what it's about. Josh, we got a couple questions here on, we got one from Alex. We'll this is a good question too. Something we often hear. What's your prediction for the spring selling season if rates continue to climb? It feels like prices continue to climb regardless of rates. So the spring season, if you will, is kind of about halfway through, if you will, right? So we're halfway through April, almost halfway, a third of the way. So we'll go until about June. In the spring season is essentially over, if you will, by then. So I think I don't know that a lot's going to change between now and June with regards to the overall market, because inventory still has a long way to go. And I don't think you're going to see an increase enough in that period of time to slow everything down quick enough. But I do think, in short, if rates continue to climb, you're either going to see what we saw last year, which is when rates hit 8%, just the market just halted to some degree, and prices just kind of moved sideways because there weren't sellers and demand was kind of at a low too. So it just kind of moved in lockstep. That's either going to happen, or you're going to get some downward pressure on the market. Orange County, Southern California, where we are, it's a bit of an anomaly because inventory is so low. In fact, we talked about it in detail in that episode that drops on Tuesday with Lance Lambert. It's a really good data driven episode. If you're good from someone, that's the first conversation we've ever had with the guy. So it's not like, hey, all these, we're just putting on people that have the same opinion. Like literally had no idea what he was going to say, and just good stuff. But in short, I think you're going to see a slowing market for the time being. I don't think you can see a strong market when rates are climbing and inventory is climbing. And when I say climbing, I'm not talking about like, double-digit growth. I'm just talking about like just more and more property. But you saw the numbers I put up at the beginning of the show. We had 135 properties in Huntington Beach. That's the lowest level of inventory we've had since 2022. So if that market stays like that, we don't see much of a change. So Josh, anything you want to add on that?
No, I would say the same thing. It's all going to come down to the strength of the market. What we're seeing here in Southern California is crazy. Just the inventory is so low that even when rates hit 8%, there was less activity, but less people looking to sell their homes, and the actual prices remain strong. The people that we did have buying were still in competitive bidding situations. So from that perspective, I wouldn't expect it to move much, but that's where that local data comes into play. We talked in the conversation today, some specific markets where there is excess inventory and you're seeing it get back to 2019 levels. And if you combine that with 8% rates, you're going to see additional weakness in some of those areas. So it really depends on where you're at.
All right. We got a question from Francie. Looking to buy a second home, but they have to pull equity from an investment property, Josh, for a down payment. Is that a good idea? They're located in Florida. So what does it look like right now to do a cash out refinance on an investment property?
Probably close to 8%, depending on loan to value, depending on credit score, depending on any number of those things. So if you have a 2% interest rate, probably not the best idea. I'm assuming these investment properties and investment, the second home's not necessarily an investment, but there is a cap or a limit on what you're comfortable affording paying. If we're talking about, hey, we owe 100,000, we'd like to take another 100,000 and it's worth 700,000. Probably doesn't matter as much about the interest rate. And if you're looking at it as, hey, the tenants will still be able to cover the entire mortgage, so it's a free $100,000 to pay for the down payment on my second home, you could make a case for it, but I would just be careful giving up a big loan at a low interest rate to get a little bit of cash. It really comes down to that blended rate. What are we doing? How are we accessing these funds? And what is the total overall cost?
No, good stuff. It's that point in the show where I ask, if you haven't done so already, hit the thumbs up. If you like the content, subscribe to the channel. If you haven't checked out the podcast this week, Josh, what we talked about insurance. We didn't know insurance was going to be a banter topic amongst groups of people who think that we are promoting the insurance companies, believe it or not. When we just gave information that Josh and I have no information, like we are as layman when it comes to insurance as the regular guy. Like we know very little about the insurance world, and we gave the information that we know, and we were seen as pushing insurance somehow, not sure how. But anyway, if you're interested in the insurance world, why you're seeing the cost increase, what's likely to happen, how that's going to impact the housing market, we pulled in some data, and that's where our information came from. But check it out. It's on the Educated Homebuyer podcast. It's a good episode. And if you listen to it, let us know if you like more episodes like that, because it's a different style of content than we've done in the past, but it's information that you need to know if you're buying a home. And lastly, what I would say is that most people are ignorant when it comes to doing mortgages and real estate. If you want a professional, there's a link, scroll in the description, actually at the bottom of the screen here, that'll get you in touch with referral partners that we know, like, and trust, and likely going to be one of us. Anyhow, that's my pitch for the night. Josh, Kim has another question. With rate cuts, would we pay higher prices for homes? So,
We would. She's saying we would. We
oh,
would pay
we
higher
would.
prices for homes, right?
Well, I mean, let me ask you that question, Josh. If rate cuts happen, so what actually happens if a rate cut happens? I guess that's a better question. And I'm not talking prices. I'm just taking what impact does that have with rates?
Well, let's say we've already
The two
seen
aren't
this.
correlated. I mean,
We
they are correlated, but they're not correlated.
Without seeing it, we already saw it. The Fed with the dot plots in Q4 of 2023 indicated that we were going to see rate cuts first half of this year, and the market improved. We went from 8% down under 6.5 for a couple of days. We saw a 1.5% improvement off of the belief that there would be Fed cuts. So when that starts to become a reality, the market may be gun shy and we may not move as quickly in that direction as we get closer to potential Fed cuts, but the market will improve. And I can tell you, I have a lot of people who are out at 7, 7 1/8, 7 1/4, 7.5, definitely out at 8% that are in at 6.5, 6 1/4. If it's an FHA, 5.99. So there's definitely more demand there. But I'll say this, Jeb, we're going back and comparing. We had a really weird time for 2 years when home prices were exploding and almost no one cared because rates were so low that the payments were still very affordable. If we had a drop to 5.5%, I can tell you on the way up from 3 to 5.5, people were like, there's no way. No one can afford at 5.5. Yeah. They weren't necessarily wrong. There's a lot of people that are still out at 5.5. Now, again, part of that conversation today was the lock-in effect was really bad in 2022 because people were like, well, I'm not selling my house. I'll wait until I get a better chance to buy at a lower rate. By the end of 2023, they're like, life is happening. Our family grew. I have a job offer. I have to do this. So the lock-in effect is less over time, but it is still there. And Jeb, you always point this out. Most of the additional inventory that would be coming in the market, those sellers are buyers. So we have increased demand. The lower rates are bringing in more first-time buyers, higher demand. But I don't think it creates a mania like we had in 21 and first part of 2022. It creates a difficult market. Lance's term was supply-demand equilibrium. So I think you remain in equilibrium. You just have a higher volume. So I think you see a lot of what we see right now. There's more homes to choose from, but more people chasing after them. So the movement in prices would likely be similar, would be my hypothesis. Hopefully we get a chance to test it, Jeb.
No, exactly. Kim has another question I'm going to throw up here. And then Kim, your time here is done. No, I'm kidding. Kim says, can you go house hunting with a pre-approval letter? Absolutely. Yes. That's when you should go house hunting, once you've been pre-approved. You don't need to carry the letter around with you, though. Just FYI. It's just for your own benefit to know you're pre-approved. When you're ready to make an offer, the realtor representing you is going to want to know that you've been through that process. It's that simple. Josh, we got Alberto, lives in a community with other houses with the same layout, I have made plenty of remodeling work in my house. Would my renovations give a smaller return on investment if other houses in the area sell for less? I'm trying to make sure, would my renovations give me a smaller return? Here's the deal. Yes and no. There's so many factors, right? So just because you have a model match home doesn't mean your home's going to sell at the same price, right? Location, side of the street. There's different things, that lot size, like, that vary on price, right? So you got to factor that in. But assuming you do improvements to your house, I think there's a misconception that when you spend $50,000 on a home remodel, that your home value just increased 50 grand. That's not the case. Your home might increase 25 grand for a $50,000 remodel. It really depends on what the other homes in the neighborhood are selling for. Now, if the homes in your neighborhood that are selling for less than, say, you own your home at, and they've been completely dialed in and yours hasn't been, and you're going to do these, yeah, you're probably not going to get any return on your investment. But on the flip side, if those homes are just builder grade and you go in and remodel the bathrooms and the kitchens and all of that, chances are you're going to get some sort of return on that investment, assuming you do it the correct way with permits and, use qualified contractors and licensed people. All of that stuff matters. So it's hard to say without actually knowing all the details, but just understand it's not a dollar for dollar deal. Look at what you're trying to do and try to find a similar home that's done it and see what that home is sold for. And then you can get a better idea of how much, ROI, if you will, you'll actually get.
Jeb, doesn't it largely come down to, if your neighbors are dirtbags and don't do any improvements, then all of your improvements are going to be hard to justify the value. But if everyone's upgraded and you upgraded a little more, but within reason, you didn't over improve the property, it should adjust out fairly well on sale, right?
Yeah. Yeah. And I think like people often have this belief again, like, hey, I just did all of this stuff to my house. I put a new water heater in, I put a new HVAC in, I did all of this stuff. Yeah, understood. But it's all what a buyer perceives as value on a property. If they don't give a shit about the water heater or the furnace, it doesn't add any value.
They have an expectation of hot water and warm air.
Yeah, they're expecting these things to actually work when they buy a home. So I think that's what people need to understand. Like, what do people focus on? In my experience, when they go to buy a home, most people are looking at kitchens and bathrooms, right? They want the outside to be presentable, right? They want to pull up and feel like, oh, this is a nice house. And they want to walk in and feel like, oh, the kitchen is done, because those are typically the most costly pieces of a remodel. Paint, flooring, that stuff is relatively cheap overall. So, just do it within reason. Again, try to find something that is comparable to yours, that's done it, and make sense of it that way. And talk to an agent. An agent in your area might be able to actually guide you a little bit. Josh, is there a loan program in California that allows multiple families, like 4 to 6 families, to buy a 4-plex or a 6-plex building that they all live in each unit? That may be a way for homeownership. Yeah, exactly. For some people.
Two important parts to the question. Anything 5 units or more is commercial. It's no longer residential. So you're looking at like an apartment loan, bigger down payment. They look largely, it's not considered owner. It's not going to be owner occupied. They're not expecting someone to owner occupy. So 5, 6, 8, 10, 12 units, absolutely nothing like that exists. 1 to 4 or 2 to 4, you can absolutely do that. 2 families, 4 families, and we say everyone's going to owner occupy a unit. We can do that owner occupied. FHA will allow it. No reason why a conventional loan wouldn't allow it. VA is not going to be in play there unless we've got 4 families of veterans, because everyone has to be a veteran, and that would be a nightmare, a split entitlement loan. But yeah, FHA or conventional, you can do that. It's going to make the file complex. And I will tell you, both in the technology of our loan origination systems and the technology of what spits out docs, there is a limit in terms of how many borrowers can be on a loan. I don't know, is that 8 borrowers? Is it 14? But there is a limit there of just technologically what's feasible.
All right. Misty says, can a first-time home buyer buy a foreclosed home? Absolutely. No reason a first-time home buyer can't buy a foreclosed home. Now, sometimes you'll have properties that are in foreclosure, go to the courthouse steps and that sort of thing. Those require cash. But if it's an REO and it's already been foreclosed on and it's been essentially repossessed, if you will, and it comes on the market as a foreclosed property, you can typically, anyone can buy it. But the easy answer is yes to all of that for a first-time home buyer.
The type of property legit does not matter. Short sale, foreclosure, bank owned, private person owned, investor owned. It does not matter. The types of financing that we're looking at, you can use to buy any home. The dynamics of it and how it's going to work are different. Obviously, other than, as Jeb said, the house hasn't gone through the foreclosure process at the courthouse steps. It's generally cash in hand. And funny story,
you could still be a first-time home buyer as long as you have the cash.
Yeah, and they don't take cash, so you can't roll up with a bag of cash. I've been there before. There's guys that literally have cargo pants on, and they'll pull out of one of those pockets an envelope of cashier's checks in different denominations and whip out $700,000-$800,000 in cashier's checks. As crazy as that sounds,
but they all have on cargo pants. Just so you know.
Got where are you going to put those pockets full of cashier's checks? You got to have the cargo pants.
That's the only reason cargo pants were made. You guys thought that Crocodile Dundee, Steve, the alligator crocodile hunter, was the only guy. No, it's made for people at foreclosures, guys. Just so you're clear. That actually, what happened was a guy went to a foreclosure and he didn't have any pockets, so he created those pants, and that's where they caught on. So just little fact for you guys. Exist and Live says, I'm ready to buy a house this year for sure. In capitalized, guys, for those who can't see it. Is it worth anything waiting a few months to see what happens to the market? So this is the same question that we ask everybody. Wait for what? What are you waiting for? Are you waiting for more homes to come to the market because you can't find the one you want? Are you waiting for prices to drop? Are you waiting for interest rates to drop? Or maybe you're waiting for rates to go higher so that demand falls and you can get a better deal. I don't know what you're waiting for. So the easy answer is buy when you feel comfortable, have some money in the bank, longer term time horizon, right time in your life, all of the things that we talk about. Outside of that, Josh and I cannot help you pick the timing. It is very, very difficult. And trying to pick the top or the bottom in a market is a fool's game.
And the piece of context we're missing there, Jeb, is where are you at? If you're in Gulf Coast, Louisiana or Gulf Coast, Florida versus Southern California, that answer is going to be very different. And that's why you need data and expertise, boots on the ground, local in your market. Jeb, we actually have a follow-up here to Alberto's question, and I like it. So Jay says, I've seen over-improved properties in crap neighborhoods sell high. And I think we just didn't close the loop on what we were saying. Anyone can pay anything they want for a house. What can be a problem is, let's say Alberto over improves his house. It's the most amazing house in the history of the world, and he's asking $500,000. All those other similar homes have sold for $400,000. If someone comes in and says, hey, Alberto has the greatest house in the world, I want it to be my house, I'll pay you $500,000. No problem. It still has to appraise for that. That's where you can get into an issue, because I would say you're right, Jeb. I've seen people, want a house really badly when the comps don't support it because it was over improved, but really it was improved the way they wanted it. Is that fair to say?
Yeah, no, absolutely. Yeah. I mean, hell, remember that house that was in the Dutch Haven tract over by where Mark was, that was improved, but it was like a
porn
70s porn set. I mean,
I have never seen more granite in one house than that ever.
Did that thing ever sell?
No, they wanted 1.8 when the market was like 1.2, and they were telling you all the reasons.
We need to go look it up and see if that thing is still on the market. Not on the market.
Just show these guys the pictures. They need to see this. I think we pulled it up. Anything quite like
I'm pretty sure we actually showed it.
Did we show it on the show already?
Because I felt like, hey, I'm not sure we should be doing this since it's in our local market, but I'm pretty sure we showed it. I don't remember exactly.
Audience was smaller.
Yeah, we actually had a 300 going audience there for a while. Now we're down to like 160, 170, which again, we're appreciative of, but we were double at one point when people were buying houses. Market's crashed now. Nobody's buying anymore. Josh, as for appreciation, San Diego versus Orange County, do you see a difference?
I don't know San Diego well enough. This is a thing that I can say, watching and working with people buying in the San Diego market. It never made sense to me, other than potentially a smaller economy in San Diego, that San Diego was a discount to Orange County. You're closer to Mexico, which the big thing that means the closer you get to the border, the better the weather is. Like Mexico has better weather than San Diego, which has better weather than Orange County. So
you get closer to the equator, baby.
Amazing weather, amazing beaches, a lot of cool stuff, and they always had cheaper prices. So the reason why they've seen greater inflation in their homes is they were unnecessarily cheap, and people sort of reacted to that. Irvine is also insane. In terms of Orange County, it's probably the most expensive of communities for what you get, because the people that want to be there want to be there. Yeah. Like
good school districts, safe, new medical facilities going in there. It's Hogue is building a whole nother facility there. I mean, it's becoming, a whole different deal. And it's a master plan community, which you either love or you hate, but it's very clean. It's, easy to get around, all of the things that make for great cities. It has. So me personally, I would choose Irvine versus San Diego, UTC area, but that's just me. But you got to do what's right for you. Josh, we got a question on basements. Not that we do any basements here. Okay, there actually are a couple houses in Huntington Beach that have basements, believe it or not. But Jordan is asking the question: is it important when selling a home that the basement has a permit done? I would say yes, without knowing the answer to that question for certain. And I would say that from the perspective of if it's permitted, chances are it's actual square footage that can be counted into the square footage of the home when selling it versus something that's permitted, not permitted, probably can't count that square foot. So if you're trying to use that square footage for a selling and value purpose, it probably has to be permitted, which I would say is important. Anything to add there, Josh?
It's an area of ignorance for me, although it would be nice to have when I see these guys with these great golf simulators in their basements. I would love to go down in the warmth of my basement in the winter and just pound balls for like an hour.
It's like, well, I've been listen, I've been crapping on the winter here. It's gotten down into the 40s a couple times. I'm used to wearing shorts a lot. I'm having to wear long shorts. I like wearing short. I like wearing short pants, guys. I've been wearing a lot of long shorts, and I don't like it. So we actually had 75 yesterday. Supposed to be roughly 80 today, 80 tomorrow. But guess what? We get rain again this weekend, Josh. We get the opportunity to get us further out of the drought. It's such a blessing. It really is. Let's see. Rumi has 20% down saved for a second home. How do I qualify for the mortgage on a second home with existing income? Primary residence has about 40% equity. So do you qualify any differently, Josh, when it comes to a second home?
No, you're going to have to carry both mortgage payments. So we're counting your primary mortgage and the second home. If we're talking a true second home, if you're meaning a second property that you're going to use as an investment, then one way or the other, we have some rents to offset some of those payments. But if it is a second home, it's just like if you went and bought a Lamborghini with a $3,000 monthly payment, we're going to hit you with that. And it has to fit within your debt to income ratio.
All right. Good stuff. I got a VA question here, Josh. I'm aware that VA education stipends cannot be considered for mortgage qualification, but if you meet the residual income requirements, will it factor into the approval with a higher DTI, say over 60%?
Jamal, you called it a higher DTI, over 60. This is amateur hour. We can get them over 70 with that residual income. I have friends who claim they've got over 80. I don't know how you could meet the residual income requirement and be over 80 unless you had like someone making $1 million a month. But I digress. So yes, if we have income that is documentable but not qualifying income, it can be a reason for exceeding the guideline ratios. And I did a video on this. Jeb's doing a video on this topic that most people just don't understand or know. Residual income. VA is the only loan program, at least that I'm aware of, that does not have a maximum debt to income ratio, and the guideline literally says loans exceeding 41% DTI or 40% DTI is not a reason for denial of the loan. You have to look further at everything else. So absolutely, it can be a factor that can be used to approve a loan, assuming you meet the residual income requirements.
Just putting this up there for some context. April says New York prices continue to rise. She's sick of waiting. Just bought second property on Long Island with an interest rate of 7%. So, Southern California is not the only market, right? We've talked about the Northeast is really, low inventory right now. Demand is still there. Areas like Southern California, Texas and Florida, Louisiana seem to be slowing down right now. More inventory on the market, a little bit less buyer demand, that sort of thing. Again, we talk about it with Lance on the episode that's going to drop Tuesday. It's good stuff, guys. That's the value is not in Josh and I coming here and chatting with you. It's in the conversations that we have with other people where we can take that information and provide it to you. In this case, you actually get to hear it firsthand from Lance if you pay attention to that episode. The other place you get to hear that information is if you go to our school community, which is in the description of the video, and hear it there, because we're taking context there, providing in there. Josh, what do we subscribe to? $3,000 or more of newsletters per year, different people?
Yep, at least.
Yeah. And so that's not information we can post. We can't take that information and just post it places because we're paying for it. It's paid stuff. But what we can do is give our opinion on it in in different places and from those places in that community. So if you're interested, you should join the community and become a member before it goes up to $20. Josh, we've got this is a question we talk about often. It's in a little bit different context, or the question is different, but I'll ask it my way. In your opinion, is it better to put 20% down on a property because you have it, or should you put less money down and keep some in the bank?
Can't unanswerable question as asked. Without the context of an individual, I don't want to see someone make a big down payment and be cash poor when they get into the home. But some people, that's the only way they can afford it, and they're comfortable with it. And they may say, hey, I'm using every nickel I have, but mom and dad won't let me fall on my face. I've got a safety net. So there are things that don't show up on a loan application or even show up in a conversation with me that would make someone comfortable with something that I'm not. So in general, I like seeing people with reserves more than I like seeing the biggest possible down payment and making them cash poor after closing. So that's the answer to your question.
Well, now I'm going to ask their question. Is it better to put 20% down on a move-in property or buy, say, something that needs some work, put less money down and remodel it?
So timing matters. We'll use this example. In 2010, I could buy a fixer out in Anaheim for $300,000. And when it was fixed, it would go for $450,000, $475,000. So we're like, yeah, I'm all in. Well, during the pandemic, when everyone wanted any property and people thought they could get a deal on a fixer and the fixer would have 9 million offers, you'd get like a $50,000 discount for that property that needs $100,000 worth of work. In most markets now, I think the market is sane enough that you're getting possibly a sufficient discount for that fixer property. So for me, this Jeb is where it comes. This is just personal preference. There's not a right answer to this. For me, I would rather have the awful house that I get to dial in the way I want versus buying a house and having someone else's taste. I missed out on one here recently. You guys know I've got a place out in Rancho Mirage with my in-laws, and one came up that had the most perfect location, and it was a gut fixer, original from 1972 and awful. Well maintained, but awful. You could not live in it the way it is. That ended up selling for $630,000. The one 3 doors down, 4 doors down, the exact same model ended up selling for $930,000, and it was all remodeled, but to someone else's taste over the last 5 years in bits and pieces. It wasn't coherent. It wasn't the way I wanted it. So to me, all day, I would buy that $630,000 property. But a lot of people, that's just personal preference. We have some friends, Jeb, some friends of mine and Angela's that that she's like, no, her husband is handy as all get out, can fix up the house. She goes, I'm not dealing with any more construction. I am buying turnkey houses. So really personal preference.
Absolutely. Willing was here early and had a question, and somehow we skipped over it. But it says, if you have somebody that hasn't filed their tax returns from 2022 yet, and you're in April of 2024, is that somebody that should be denied? Is basically what they're asking. Could they file today and send copies? So I'm going to give my answer. If they're from 2022 and they haven't filed, I'd say move on. But Josh, what's your thoughts?
Quitter. I have someone right now, a listener to the show, Jeb, that if I had quit on them, they wouldn't be able to buy their house. Filed the 22 and 23 returns here at the same time.
It's
so as long as they
that you
file
filed 23. That was important. Yeah.
As long as they file them and pay the taxes due, because the lender is going to say, cool, I want to see that you actually paid. They're not going to go, hey, you didn't pay on time. They're going to go, did you file the return and did you pay what was owed? And can we get a transcript from the IRS? More importantly, you didn't say, Willing, whether this is a self-employed person. If they're not self-employed, I don't need their tax returns. If they're self-employed, this is the craziest one, Jeb. For that borrower, we ran the automated underwriting. If it had come back and said 1 year tax return findings, we don't worry about 22. They don't go back and say, hey, did you file your tax returns for the last 10 years? You could be in big, giant trouble with the IRS. And if they haven't filed a lien or a judgment against you, you provide the most recent year's tax return and all good.
Good stuff. Let's see here. We've got Um, Ryan, $300,000 salary, asking if they'll ever be able to buy a home in Los Angeles, South Bay area. So two different areas. South Bay area, probably a little bit more tough versus areas of Los Angeles, right? $300,000 salary. What does that break down? 25,000 a month, Josh?
Yeah. Yeah.
$25,000 a month. You know, you buy what? $1.5 million home in this market, you know, put 20% down, you're financing 1-2. That payment with taxes, insurance, everything's probably going to be close to $9,000. I mean, in theory, you should be able to qualify with the $300,000 salary, depending on your debt load. Just a guess. But if you're looking to buy a $2.5 million home, and or if you don't have the money for a down payment, that's where it becomes a little bit more stressed. That's more difficult to do. But somebody making $300,000 a year, that's a realistic salary to buy something, but it's not going to get you a house on the beach. It's not going to get you the perfect house in the perfect neighborhood. And it sounds crazy because $300,000 is a lot of money, but it's not so much money that that you can just go do whatever you want. And you realize, Ryan, that you're in one of the most expensive markets in the world when it comes to buying real estate. I mean, take that $300,000 salary and go east a little bit, and you can buy, the mansion that we're talking about. So I know that doesn't help you out, but it's the easy answer is yes. It's just it comes with what you're willing to sacrifice on in a property. Frenzy says, how do you join the community? There's actually a link, I believe, in this video, Josh. Is there not in the thing below? I can't see it because I'm on the computer where you could actually check it out. I will look right now, and if not, I'll copy it and send it in here for you. But anyway, I'll post it in just a minute. Did I not?
See if it's there. And I've got a couple of easy questions to knock out here. Don Draper says, will you ever tell someone not to buy? We told someone, was it 3 weeks ago, 4 weeks ago? We had someone here on the show ask us some questions. We went through the data. Not everyone is in the position to buy. Not everyone.
Josh, I did too. I got a story. I'll tell you.
Tell us.
Yeah. LA, one is a professor at SC. One is
you told me about this.
One is an attorney. They live in Beverly Hills in, I guess what would be considered affordable housing in Beverly Hills. Some sort of stipend deal. I think they pay $3,500 a month in rent. And she says, does it make sense for me to buy? And I said, how much are they raising your rent per year? And we talked through everything, how old her kids were, what their plans were, all of these things. And at the end of the day, they were able to basically they were able to put $7,000+ a month away into savings and investment accounts. And they were saving almost $100,000 per year when it all came down to it versus owning a home. And I said, hey, here's the deal. Chance, you're not going to get that same return by buying a property at what you're looking at. And the key is with buying a home is to fix your housing costs as early as you can in your life. If your current landlord isn't raising your rent at a rapid rate and you're comfortable staying where you are and you're able to put that much money away, you should just rent. Like, your kids are getting older. They're going to move out at some point. You're not going to need the same property that you need now, and you can be able to do whatever you want. And so her and I came to the conclusion that she should not buy because it didn't make financial sense for her to do that. But because you're asking the question, you're being sarcastic. It's one of those questions that, hey, listen, it's, most people want to become homeowners. And so you've got to figure out it for yourself. If you're asking the question, if you should buy, chances are you shouldn't. I mean, that's the easy answer for most people. If you don't know, then you probably shouldn't. But that's not for Josh and I to we're not telling anyone to buy here. We're giving you the guidance so you can make the decision for yourself. But Josh, anyway, carry on.
Well, we've got another really good question here.
Yep.
Fight breast cancer. At first, I thought it said fight breast cancer not. And I was like, well, that's kind of rude to say not fight breast cancer, but it says what. I don't know what means, but I'm assuming it means do fight breast cancer. I have a primary residence with a conventional loan. Am I able to move to another house with an FHA loan? Answer is yes. FHA has an interesting rule that a lot of people lose sight of. It's a new one just in the last 10 years that if you move within 100 miles of your current residence, regardless of the financing on that residence, you cannot use any rents to offset that payment. So almost like going back to that buying a second home, you would have to qualify for both mortgages if you wanted to use FHA. If you were going to go conventional, conventional will allow you to use 75% of the rents to offset the current mortgage payment. Another change just in the last year with Fannie and Freddie, you cannot, if 75% of the market rents exceed your mortgage payment, we can't add that to your income any longer. We can only use it to offset unless you have a landlord history, meaning you own other rental properties and you have a history of successfully being a landlord.
All right, good stuff, guys. Been on just over an hour. If you haven't hit the thumbs up, do so. Subscribe to the channel. Go check out the Educated Homebuyer podcast. More importantly, if you're looking to get a mortgage, you want to get pre-approved, you want a second opinion, refinance. Believe it or not, there are people refinancing right now. There is a link scrolling right there that'll get you in touch with our team. We can guide you through the process. We would love that opportunity. But until next time, guys, we are out of here this week. Adios.
Amigos.